These stocks offer some of the safest opportunities in the storm. These 7 safe stocks offer the opportunity for price appreciation with relatively low volatility. Hershey. Strong results will likely continue to keep investors sweet on this confectionery. Lockheed Martin. A recent analyst upgrade suggests growth is about to reaccelerate. NextEra Energy. This electric power company's high exposure to clean energy makes it a strong choice. PepsiCo. Dividend growth gives this safe consumer staples stock the edge over its longtime rival. Procter & Gamble. This blue-chip household products stock offers the opportunity for steady returns. Philip Morris. Philip Morris's move to go smoke-free may make it the safest tobacco stock out there. United Health Group. This healthcare services stock is a strong opportunity. Let's dive in. Here are the 7 safest stocks you can buy in February 2023. Welcome to Timely Investment Research. With the economy and the stock market not fully out of the woods, my suggestion is to focus on the safest stocks at the moment. With the most recent statements from Federal Reserve Chairman Jerome Powell suggesting that interest rates will keep rising and that a Fed pivot isn't just around the corner, the overall market's strong performance over the past month could give way to another broad market sell-off. That in mind, now is the time to cycle back into safe stocks. Offering lower volatility, steady dividends, and the potential for gradual appreciation, these 7 safest stocks could also receive a short-term lift if today's risk-on investors seek safer harbors. Number 1. Hershey. Shares of Hershey have continued to perform strongly. Shares stayed in the green during 2022, as Hershey's underlying business continued to crush it, despite challenges such as inflationary pressures. So far in 2023, Hershey stock has continued to perform well, even as investors opt for the riskiest stocks rather than the safest stocks. However, if sentiment soon changes again, Hershey may not necessarily join in on the sell-off. In fact, if the company continues reporting strong earnings growth, as it did in its latest quarterly results, shares could keep climbing higher. Besides appreciation potential and very low volatility, Hershey's beta, or volatility, compared to the overall market is 0.35. This stock also provides investors with a steady, growing dividend, 1.71% forward yield. The company has raised its payout by an average of 8.74% annually over the past 5 years. Number 2. Lockheed Martin. Lockheed Martin isn't just a defense stock, it's a defensive stock as well. With the recession-resistant nature of its business, it's a high-quality stock to buy and hold in all markets. While shares initially pulled back at the start of 2023, shares in this low-beta, 0.68, stock are bouncing back. To some extent, this Lockheed Martin stock rebound may be happening on the heels of a recent analyst double upgrade. On February 6, Credit Suisse's Scott Deuschle raised his rating on Lockheed Martin from underperform to outperform, basing his decision to upgrade on factors such as the defense contractor's rising book-to-bill ratio, a sign of growth reacceleration. Shares could potentially move higher in the coming year in tandem with this expected earnings growth. This safe stock also offers investors steady returns via its 2.56% dividend. Lockheed Martin has a 20-year track record of dividend growth. Number 3. NextEra Energy. It's no secret that many of the safest stocks are utility stocks. Yet among scores of choices, NextEra Energy may be your best bet. Yes, NextEra Energy's beta, 0.44, is on par with most utility stocks in the sector. Shares in this Florida-based electric power company also sell at a valuation premium to other major names in the sector. So then, what exactly makes NextEra Energy stock a standout among utilities? That would be its high exposure to the renewable energy megatrend. NextEra Energy's clean energy business will keep driving growth, which explains why the stock is a favorite among sell-side analysts. In turn, continued earnings growth likely means continued dividend growth. While offering a lower yield, 2.25%, than peers, NextEra Energy has raised its payout by an average of 11.6% annually over the past 5 years. Number 4. PepsiCo. The consumer staples sector is another area chock full of safe stocks. PepsiCo is one to consider adding as a safe harbor play. Sure, you may be thinking, why PepsiCo rather than Coca-Cola stock? Yes, PepsiCo stock and Coca-Cola stock are similar in terms of their main business, soft drink, as well as stock-related metrics like beta, 0.57 for PepsiCo, 0.56 for Coca-Cola, and valuation, mid-20s earnings multiple for both. Still, something else may give PepsiCo the edge in this cola stock war. PepsiCo and Coca-Cola are each dividend kings, and Coca-Cola has sport a slightly higher yield, 2.93%, versus PepsiCo's 2.68%. However, raising its payout by an average of 7.4% over the past 5 years, versus an average of 3.53% for Coca-Cola, a higher level of dividend growth may enable PepsiCo to outperform its long-standing rival going forward. Number 5. Procter & Gamble. Procter & Gamble is a blue-chip stock straight out of Central Casting. A more than century-old business, shares in this household products powerhouse have rewarded investors for generations, with steady dividends and growth. Even today, owning Procter & Gamble stock can provide your portfolio with solid returns. Investors seeking safety should appreciate its super low beta of 0.4. Although shares may seem pricey at around 24.5 times earnings, Procter & Gamble is likely to maintain this valuation as it continues to consistently grow earnings. Current sell-side estimates call for earnings growth of around 8.2% next fiscal year, ending June 2024, and 9% in fiscal year 2025. Add in Procter & Gamble's 2.58% dividend, which has increased in each of the past 66 years. And it's clear that Procter & Gamble shares are in a strong position to provide investors with satisfactory returns, with much lower volatility than the overall stock market. Number 6. Philip Morris. Among top tobacco stocks, Philip Morris could be the safest in the bunch. Although it trades at a higher valuation and a slightly higher beta than, say, its former parent company Altria Group, the company's greater level of success so far with going smoke-free may give its shares an extra degree of safety. As I argued recently, Philip Morris's IQOS heated tobacco product, plus its recent purchase of smokeless tobacco and nicotine products maker Swedish Match, give it far greater exposure to growing segments of the tobacco industry. This could outweigh any possible declines in its legacy cigarette business if the smoking rate keeps dropping. In addition to greater growth potential, Philip Morris stock also offers investors a solid dividend forward yield of 4.97%. This dividend has grown steadily, increasing by an average of 3.62% annually over the past 5 years. Number 7. United Health Group. Selling off recently, on news of a lower-than-expected increase in Medicare Advantage payments this year, United Health Group may not be acting like a safe stock right now. However, when looking on a longer time frame, United Health Group stock remains less volatile than the overall stock market, with a beta of 0.69. This provider of health insurance and related services is not only still a safe stock, United Health Group remains a high-quality growth stock as well. Analyst forecasts continue to call for United Health Group to grow its earnings by double digits over the next 2 years. Chances are that achieving this will result in a similarly sized move higher for shares. Along with earnings growth, United Health Group offers investors the opportunity for dividend growth as well. While its current payout may seem low, 1.39%, United Health has raised its dividend by an average of 17.4% annually over the past 5 years. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.